Hello and welcome to the latest video with Money to the Masses. I'm going to be asking Damien lots of questions about different investment terms to help you who, if you currently invest, understand the terms in a bit more detail, or if you are thinking about beginning investing, have a better and clearer understanding of what all of these terms mean. So to get started, Damien, what is a unit trust?
Right, there are different types of funds. So I used the word fund previously, and there are different types. So a unit trust, there are investment trusts, and there are ETFs, which stand for exchange traded funds. And the difference is in the structure, the way the fund works. And so I'm going to run through it really quickly. I don't want us to get bogged down in it, but a unit trust is open-ended. So that means that the fund manager will create more units. It's a unit trust. So when you buy a stake into his fund or her fund, you get so many units. You don't get shares from the companies that they're investing in the underlying fund. You get so many units. So let's just use an example. You get 1 unit. If I come along and I want to invest some money, I give them money and they might give me however many units based on how much money I invested. Yep. The units have a price. So the more money you put in, the more units you get. But of course, there are so many units in this fund, and therefore, as the unit price goes up, then your share will go up. So your share of that unit that you own. So if you own 1 unit and I own 2 units, obviously, if the unit price goes from £5 to £10, then your stake goes from 5 to 10. Mine will go from 10 to 20. Does that make sense? Yeah. So, but what it does is it's important because the way it works is with a unit trust, it's open-ended. So the manager, if you want to sell, you go back to the manager and say, I want my money back. And therefore they have to give you your money back. That's how it works. And in a normal functioning market, that's great. But if you get to a case which we had recently, if you ever want to know how this can go wrong, search the name Neil Woodford. If you had a lot of people suddenly want their money out, then that manager's got to give them their cash back. But if you imagine that's invested in shares, for example, they might have to start liquidating some of the assets to give people their money back. And if everyone did that, that would drive down the price of the fund itself and the people who stayed in it, because all the assets becomes a fire sale. You can get a vicious circle. We don't want to get into it, but it can be a problem sometimes. But it's the most common way of owning investments, unit trusts. So one of the other things to bear in mind is that they're only priced daily. So when you sell a unit trust, you get the price as of the next pricing point. So they're the most common type. So they have their drawbacks and their positive elements. So they're very easy to use, are widespread. Now investment trusts are slightly different. They're not open-ended, they're closed-ended. So what they really like is if you imagine there was a company created and all they did is they just invested in other company shares. What you're doing is you're buying a stake or a share in the investment trust as a company. It works, if you got what I mean, it works the same way. So what happens is that when you decide you don't want your stake in that investment trust anymore, you sell it to somebody else rather than the manager giving you your money back. And so you don't run into some of those issues that occur very, very rarely that you get with unit trusts, where people have to sell down assets to give you your money back. You just say to me, Damien, I don't want this anymore, I'm going to sell it to you, in a simplistic way. So they can trade at discounts and things. It's a different type of fund, but they can be operating very much the same way. But they're quite good for something like property, illiquid assets, because you don't get that issue where you can't trade them, where you get that liquidity issue. They are traded all the time throughout the day, so that's a positive. They probably aren't as well researched, there's not as much information out there for people, and they weren't as readily available for people to buy until very recently. And the final one is ETFs. Now ETFs seems to have the best of nearly all worlds. They can be traded all the time during the day, they're very cheap, they can often be passive as well, and you can trade them. There sometimes are, though, additional costs with investment trusts and exchange traded funds, ETFs, that when you trade them there are costs involved. So every time you sell one or buy one, you might have to pay a fee. With unit trust, almost universally there are no fees when you trade them. So that makes them more attractive in some ways. So all you have to bear in mind is there are slightly different structures that operate in slightly different ways in terms of how you buy and sell them, when you buy and sell them, like in terms of trading frequency, but they are ways to invest. So it's a slightly different structure, but fundamentally it is about what they invest in that's important.